and a very warm welcome to all of you. I hope all of you are safe and maintaining good health. Today, I'm going to share with you key highlights from our recent study on trends that we are seeing for brokerage houses. After record high client additions and average daily turnover in a pandemic-marred fiscal 21, brokerages will continue to see positive revenue growth in fiscal 22. Nevertheless, the growth will be muted. CRISIL Ratings estimates broking revenue to have grown by 65 to 70% in fiscal 21 as against 7% in fiscal 20. But market volatility and phased implementation of new margin regulations may act as a drag on incremental volume growth, resulting in only a marginal revenue growth in fiscal 22. Actually, the slowdown has already begun to tell. Broking revenue degrew by 1 to 8% in the third quarter of fiscal 21 on a sequential basis. This indicates that client additions are not translating into higher broking revenue of late. In the first 9 months of fiscal 21, brokerage houses on an industry-wide basis added 52 lakh clients, as much as they did during the preceding 4 years on a cumulative basis. This took the active client base to 1.6 crores as of December 2020. Continued buoyancy in equities and new client additions also led to average daily turnover hitting decadal highs. Several factors contributed to the influx of retail investors into equity markets in fiscal 21. These include 1. User-friendly trading platforms including on mobiles and schemes with very low brokerage. 2. Relatively low interest yield on savings and deposits. 3. Ample time availability during the lockdown and pandemic. And 4. Broad-based high returns in equities since March 2020. And in all this, interestingly, discount brokerages grabbed a significant market share of active clients. But they still lag behind bank-led brokers in terms of revenue market share. On new client adds, discount brokers have led from the front, capturing more than 75% of incremental client acquisitions and now command 45% market share in terms of active clients. However, on the revenue front, they still have some way to go with an estimated market share of 30%. Bank-led brokers with a relatively premium brokerage model have leveraged their existing client base well and continue to maintain revenue market share at 40%, while many traditional brokers have lost ground. In this milieu, profitability will continue to be driven by how well players manage their cost-to-income structure. A recent shift in focus towards creating and enhancing technology-based platforms resulted in a steady increase in cost-to-income ratio till fiscal 20. And players who invested in enhancing their digital presence have reaped their rewards since then, with the cost-to-income ratio estimated to have declined 10 to 15% in fiscal 21. And on that note, I thank you for your time and attention. Till we meet again with another topical theme, goodbye.